Whether you want to retire for good or just achieve financial independence, most of us would like to hit that goal sooner rather than later. So, how can we escape the middle class trap, gain back our own time, and focus on our priorities? Subscribe to the channel and join me today to see my plan for early retirement right here in the Red Zone. In our younger years, we used the rule of 25 to estimate the amount of money we needed to one day retire. At that time, we took 25 times our expenses to get our financial independence goal number. Once we were halfway to that goal, we stopped, reassessed, and started to think about how we could turn our savings into an income stream. Now, in order to figure out what we need, the first step is obviously figuring out what we spend. We then need to break those expenses down into necessary expenses like food, housing, transportation, and a big one for retirees of any age, healthcare. And obviously, early retirees need to buy on the exchange rather than get health insurance through their employer, and our more discretionary expenses like those men's basketball tickets in Rupp Arena. Well, those may be necessary as well. If you've made it this far and you're considering early retirement, you likely have done well in your 401ks and IRAs. And if you're over the halfway point to whatever number you had in mind, you can literally not invest any longer in these accounts. Let compounding do all of the heavy lifting from here and just retire at a more traditional retirement age. The fact that I am over halfway there and also because I want to retire early is why, among many other reasons that I lay out in this video, that I'm investing into my brokerage account rather than maxing out my 401k. The basic problem we have in early retirement is that we need to bridge from that early retirement age to our non penalty retirement account age of 59 and a half, or potentially our Social Security claiming age between 62 and 70, depending on our plans, or our Medicare age of 65. So, how can we build this bridge? Here are some approaches. I want to be clear that I'm not recommending any of them, they're just some ideas. I'll show you what I'm actually doing toward the end of the episode. First, we can tap into our 401ks in three ways. Our 401k may allow for the rule of 55, which allows penalty free withdrawals for whatever amount we want, as long as that 401k is from our current employer and we quit working for that employer in the calendar year we turn 55 or later. However, not all 401ks allow for that rule to be used. If not, the other penalty free option is the substantially equal period payments, also referred to as a 72T. Keep in mind, if you decide that a 72T is for you, you are locked into that plan with no adjustments for at least 5 years if you want to avoid penalties. Finally, we can always just take dollars from our 401k and pay the 10% penalty in addition to taxes on that income. Although this is the least preferred option, if you have the assets and you want to retire, this could be a viable option depending on your expenses and overall tax situation. In other words, I wouldn't allow a 10% penalty to prevent you from having to show up to a job you hate if you have the financial resources long term to do so. The trade off to any of these 401k early withdrawal strategies is that the remainder of your assets would have to cover both longevity and inflation risk as you draw down your 401k early prior to a potentially lengthy retirement because you're retiring prior to the traditional age. Second, we could build a bond ladder to serve as that bridge. An example will make this easier. If our red zone investor is 45 and wants to retire at 55 and has enough now in their 401k or Roth IRA to cover retirement at a more traditional age, for the next 5 years, he or she could buy a 10-year treasury note that will not only earn approximately 4% along the way at current rates, but it could also be money accessible in this bridge period. Then at 59 and a half, our retiree could tap into either their 401k or Roth IRA, depending on their tax strategy. Third, we can use our Roth IRA, but we can only take from the contributions that we made, not the growth portion without penalty. Many red zone investors have been contributing to their Roth IRAs for at least the last 20 years in our previous example, and likely have or will have approximately 100,000 in contributions if they retire at 55 that they could withdraw prior to age 59 and a half. That could be approximately $2,000 or more per month. Fourth, we could buy an annuity. Annuities are virtually guaranteed, and for the most part, you are trading future potential growth and legacy for a monthly paycheck. Fifth, we can invest in income producing assets paying out between 8 and 10%. Each year, starting at 45, to continue our example, our future retiree could invest new money into income producing assets to bridge this gap or transition some of their existing brokerage account into these assets as they got closer to their early retirement age. The downside here is paying taxes on the income, both as you are accumulating and living off the income once you retire. However, some allocation to income investments could end up protecting your legacy goals, mitigate or even avoid sequence of returns risk, and prevent us from doing number six in down markets, which is sell assets in our brokerage accounts. Although this puts future growth, income, and legacy at risk, if the 401k or IRA balance is large enough, then this is what you saved into a brokerage account for. Maybe you did, but I didn't put money into a brokerage account just so I could retire in my mid 60s when all of my retirement accounts and Social Security are available. Number seven, we could invest in physical real estate and generate rental income. I personally don't do that, nor do I have an interest in becoming a landlord, but many in the financially independent retire early or fire community have used this approach successfully. Instead, my real estate investments are in the form of REITs, which I introduced in this video. Finally, we could work part time. This could be continuing your side hustle, consulting in a field you've built expertise in, or any number of ideas that don't require your full attention in terms of 40 hours a week, but at the same time cover some amount of expenses, which can also mitigate against selling assets when they've declined in value. There are probably a few more that I'm leaving off, so feel free to leave a comment and let the community know. If you're planning to retire early, what's your strategy to bridge when your retirement accounts are accessible without penalty, or maybe even your Social Security claiming age? So, which one of these options will I be using? First, about 30% of my bridge spending will be covered via a pension. This obviously makes things a lot easier, but as you all know, there's no such thing as a free lunch, or said another way, every choice has a trade off. In this case, my trade off has been a 401k balance far, far below that of my peers. The next 20% will come from a bond ladder that I'm currently building. Step one of that bond ladder is bridging from early retirement age to age 59 and a half. Step two of that bond ladder is spread from roughly age 60 to age 67 in much smaller amounts as a partial mitigator to sequence of returns risk in the first few years of a more traditional retirement age, and bridges to my full retirement age for Social Security of 67. The next 40% will come from my taxable brokerage account, primarily in the form of income producing assets, which, as stated earlier, I'm currently putting new investment dollars into while just keeping my 401k contributions at the employer match level. The downside of this approach, as stated earlier, is the increase in taxes paid now and the tax drag on my portfolio in my brokerage account. But those numbers have been crunched, so to say, and is a trade off I'm willing to make to buy my freedom at an earlier age. As you can see, I'm still projected to be about 10% short, but all of my necessary expenses are covered. So I have some options here. I can pull from my 401k, pull from my Roth IRA contributions, or take a part time job. Either way, the math works in terms of conservative projections, so it depends upon what type of part time work I'm able to find and if I still want to work anymore. I haven't really decided. So, how are you planning to build your bridge to financial independence or retire early? Feel free to leave a comment below and let the community know what you're planning to do. Until then, I'll see you next time, right here in the red zone.